Let's take a look at markets and how they ended another wild week. A big jump in the jobs report on Friday. 467,000 jobs were added to the economy in the month of January. The estimates called for job growth of only 150,000. Meanwhile, the unemployment rate ticked up slightly to 4%, up from 3.9%. Joining me right now is Slate Stone Wealth Chief Market Strategist Kenny Polcari and Employ Bridge Chief Workforce Analyst Joanie Bily. Great to see you both this weekend. Thank you so much for being here. And Joanie, let me kick it off with you. Assess for us, if you will, the jobs report for January. What struck you most?
Well, it was a big surprise, I think, for all of us and economists, certainly to see 467,000 jobs created. But the job growth was really in all sectors, Maria, maybe with the exception of construction, which was surprising to see a decline, but very strong growth in leisure and hospitality, the professional business service sector, retail performed well. So lots of job opportunities out there, and really great to see labor participation tick back up. We're seeing more people come back into the workforce, and that certainly is a good sign. So even though we saw unemployment tick up slightly, it was actually for a good reason this month.
Yeah, I mean, initially, Kenny, when the market saw this number, we actually saw a real volatility and a decline. I wonder if the market sees this number as an opportunity to say, yes, the Federal Reserve will now raise interest rates multiple times this year, because going into the number with the ADP number and the Atlanta Fed calling for growth of 0.1% in the first quarter, questions had risen about how many rate hikes the Fed will have to do. Does this report change that?
No, but what I think it changes is the increment that they're going to raise rates, right? Because 50 basis points is very much on the table after this report. Because, look, we got a great jobs growth for January. December was revised up strongly as well. And so, therefore, I think that once again causes people to start to consider, okay, is it 25 basis points or is it 50 basis points? Because remember, that's been kind of the talk going back and forth, and there have been arguments both ways about why they should, why they shouldn't. And I think this report brings up the possibility that that could happen. Although Jimmy Bullard did come out earlier in the week to say, 5 rate hikes is probably a good bet, and they're all supporting 25 basis point increases. So that's what I think is going to cause some of the angst and volatility in the market as investors try to figure out what's really next.
So, Kenny, most people expect incremental rate increases. So a quarter point in the March meeting, another quarter point at the April-May meeting. Do you think a 50 basis point hike as opposed to 25 basis point, quarter point, will upset markets? Is that going to be a surprise?
Well, it's going to upset markets for sure, because it's going to be a much bigger increment than what the market expects. But that then may allow them to take a step back in April or May, right? Because if they double the rate of increase in March, then they could step back in April, May to see what it does to the market, what's it going to do to inflation, what's it doing to the other data points, right? That's what I think it has to do. It almost has to shock the markets a little bit.
Yeah, I mean, you make a great point. It's about inflation, Joanie, and we've got oil prices above $92 a barrel on Friday. Inflation has zapped some of people's wages. In this report, we have wages up 0.7%. But let's face it, if people are spending more money on gasoline and on crude oil, that's going to zap their wages. Your thoughts on the wage picture in this report?
Maria, I see it in the front lines. Really, all employers right now are forced to increase their wages, from the lower skilled workers to the very skilled workers. It is one of the most competitive employment markets I've ever worked in, and I've been in this industry for 25 years. But I do really see that wages are not keeping up, of course, with inflation, even though we did see a nice increase. We all know the price of gas, the price at the grocery store. People are starting to struggle more with putting food on the table when their dollar isn't going as far. So I do think we're going to continue to see that wage pressure. It certainly will impact earnings for many companies. And, you know, I do think employees are really in the driver's seat right now. They're able to certainly demand the higher increase in wages because there is such a scarcity of talent still in this workforce. But again, a good sign that labor participation went back up, and that's probably driving it as well.
Kenny, real quick, how do you want to allocate capital? Does this report change how you're buying or selling stocks?
No, not at all, because I'm allocating new money into the value names, the cyclical names, industrials, financials, energy, which I have been, screaming about for 4 or 5 months. I might pull back on that a little bit because it's had such a dramatic move. But cyclicals, like I just said, the consumer staples is an area I think that's going to do very well this year. And look, I'm also leaning more towards high dividend growth, high dividend stocks that are going to provide stability and income in kind of what's going to be a turbulent environment.
Kenny Polcari, Joanie Bily, thanks very much for being here this weekend. We so appreciate it. We'll see you soon.